US banks will start reporting second quarter earnings results later on this week. This comes as new banking regulations are making headlines given the failures of course, Silicon Valley Bank and Signature Bank earlier this year. The Fed's VP of Banking Supervision stated on Monday that banks with at least $100 billion in assets could face higher capital limits. So is that all banks should be worried about? Well, not really. There's also historically high interest rates. Let's bring in Yahoo Finance's David Hollerith to discuss this more. Hey, David.
Hey, Rochelle. So yields for the deposit rates at U.S. banks have reached highs as of the end of the second quarter that haven't been seen since 2007 and 2008, and that's according to bank rate data. So that's good for savers, but obviously it's not good for banks. Now, historically, higher interest rates mean that banks have an advantage of being able to charge more for their loans than their deposits, and that was largely the case until we saw these bank failures earlier this year, which has sort of changed the calculus a bit, to quote the Fed's vice chair, Michael Barr, speaking yesterday. So what banks are in for now is that for the second quarter, they've seen a rising cost in deposits. And that's led a number of them, especially in June, to sort of revise what their expectations for profits are for the quarter and for the full year. So what we're looking at now is a situation where most of the analysts we're speaking with ahead of earnings are saying that, really the expectation is anybody who can stay the course or doesn't offer downward revisions to their guidance or in their results are probably going to be sort of an upside surprise. In this situation, I'll also point out that the big banks, as with last quarter, are still favored to come out looking a lot better. They're better positioned. They have higher capital requirements. So we're expecting, JP Morgan is coming in, at least by consensus estimates, to be about 40% higher year over year in net income. So it's going to be a similar story to last year. I mean, more of an earnings story as opposed to, I guess the crisis in deposits that we saw last year. But as we stay in this higher interest rate environment, it's going to be much tougher for the regional and mid-sized banks. And, they're getting squeezed. And the question is, how squeezed are they for second quarter?
And we'll certainly be tracking that. We know that's a concern the Fed was saying might not show up until this coming quarter there, so something we'll definitely be tracking. Thanks for getting us up to speed. Our very own David Hollerith there.